Welcome to the third series of our Financial Foundation Educational Program. My name is Rochelle Delia, and I'll be presenting today. I'm the co-founder of Housing Joint Venture. Today, we'll be discussing building wealth. So hopefully you've had a chance to view the first two modules, and this one will build upon our success. So let's jump right in. The goals for this workshop are all about asset accumulation. First up, we want to leave with a better understanding of how to earn a reasonable rate of return on your resources. We also want to appreciate the effects of time and taxes on our assets' ability to grow, and to be able to understand some of the differences between the mutual fund and fixed and variable annuities. Excuse me. As well as knowing the difference between active and passive management on your resources. And finally, we'll discuss how to take care of your children and their future university or college needs. So let's get right to it. Here's the main takeaway. It's never too late to build wealth. You just have to decide that you're ready and that you're willing to commit yourself to the practice. So here's a wealth formula. Do you know it? The wealth formula is money plus time plus or minus a rate of return minus, of course, inflation and taxes. That is what's left over is your wealth. So a lot of us thinking, hey, it's just about how much money I make, but really and truly, you can't just think about the top line. It's all about that bottom line. So the sooner you're able to make money, the more time it has to grow, and the better you're able to put it into vehicles that allow you to earn a healthy rate of return. But you can't forget about inflation, and you can't forget about taxes because, they're kind of like the silent killer to wealth. So essentially, building wealth is a mathematical problem. If you can increase the pluses and decrease the minuses, your wealth is going to grow. However, if the minuses, taxes, inflation, your rate of return, if they're bigger than your pluses, you're out of luck, Chuck, and you're going to lose. There's a high cost to waiting. Investing early versus waiting longer. So let's go through an example. We're going to discuss Mr. Start Early and Mr. Wait Longer. Okay? Each of these guys has $3,600 that they're going to put aside for their future. Mr. Start Early puts away $3,600 per year for 7 years only, and he puts it in an 8% tax-deferred account. Okay? However, Mr. Wait Longer invests the same $3,600 per year. He does it for 17 years in a tax-deferred account. The only difference is he starts 7 years later than Mr. Start Early. Okay? Let's see how this plays out. Mr. Start Early starts at age 25. He puts away $3,600 per year for 7 years and then stops. Okay? At age 48, of course, this is assuming an 8% annualized return. At age 48, he has $128,000. Okay? His total contributions were $25,200. Let's compare that to Mr. Wait Longer. So remember, Mr. Wait Longer said, I'm going to live my best life in my 20s, and I'm going to start saving in my 30s. So he started 7 years later at age 32. Same account, 8% tax-deferred account. At age 48, Mr. Wait Longer has $131,221. So they ended up about the same, but how do their contributions differ? Mr. Wait Longer had to contribute $61,200 just to get a similar return to Mr. Start Early, who only put in $25,200. So the sooner you start, the better off you'll be, because essentially time is on your side. Let's revisit the rule of 72. We talked about this a little bit in workshop number 1, so let's just refresh our memories here. So the rule of 72 is essentially a rule of thumb that you can use to determine how quickly a balance will double. And that's assuming that there are no interim payments will be made. So this can work for you or against you. So if we're talking about a savings account, the interest rate will tell you how frequently your balance will double. If we're talking about debt, let's say for a credit card, we're discussing how quickly your debt balance will double. Okay, so it can either work for you or against you. So let's go for this example. Rule of 72. Let's assume you have a 4% interest rate. And just to be positive, let's assume that this is a bank account, okay? So your bank account pays you 4% annually. Okay? That means that your money is going to double every 18 years. Alrighty. So if I'm at age 29 and I have $10,000, every 18 years means at age 47, I have 20 grand. At age 65, I have 40 grand. 40 grand isn't bad, but I'm sure we can do better. Let's assume we get 6%. That means that your account doubles every 12 years. Things get a little more interesting. So if I start out with my same $10,000 at age 29, by the time I'm age 65, I have $80,000. It's literally double. It's only 2 percentage points higher, but my balance doubles. Same age, 29, $10,000, but this time I have an 8% return, which means that my account balance doubles every 9 years. At age 65, I'd have $165,000. Again, essentially, at every 2 percentage points higher, your balance doubles. Of course, when you play this out to age 65 in this example. And at 10%, you'd have $320,000 because, hey, your money's doubling every 7.2 years. So the sooner you start, the better. And also, you want to get the highest rate of return that you can on your money so that your money can double and actually be there for you in the future. So really, if you take time and the rule of 72, then you're able to really supercharge what you're doing. So the difference between 6% and 10% at age 65 was $240,000. That's it. 4 percentage points. And it's extrapolating that out over essentially a 30-year period was $240,000. What happens at 10% if I stop 7 years too soon or start 7 years too late? Right? Essentially, you lose out on $160,000. Excuse me. What are you earning on your savings? Typically, banks are offering less than 1%. So if you're not seeking out higher rates of return, you really are losing. And the difference between 10% and 8% really is taxes, okay? So at 10%, you'd have $320,000, but at 8%, you only have $160,000. So that additional 2 percentage points basis really does matter. So if you're allowing the tax man to really shave off the top early on, you're cutting yourself off at the knees, okay? So let's talk about stocks, bonds, bills, and inflation. And we're going to talk about the time frame between 1926 and 2013, okay? So this era had really turbulent markets, ups and downs, and there was a need, and still is a need, to protect against downsides. So if we look over this time period, there was a compounded annual return. If you look at small stocks, so these would be small, not your big blue chips, but smaller companies, they returned an average of 12.3%. Larger stocks, think like IBM, Apple, Disney, they returned 10%. Government bonds were about 5.5%. Treasury bills or T-bills were 3.5%. And inflation ran about 3% per year. So let's look at those annualized returns from 1993 to 2012. And we're just going to compare these different asset classes. Okay? So the S&P 500 over 1993 to 2012, so approximately a 20-year period, returned an annualized return of 8.2%. Bonds gave 6.3%. CDs, so we're going to different levels of security, right? So CDs, certificates of deposit, were 3.5%. Houses, 2.7%. And the average investor, you and me, mom and pop, got about 2.3% annualized returns. So the question is, where's most of your money invested? And really, is your investment in a taxable, tax-deferred, or tax-advantaged account? Because again, if you remember from the previous slide, we noticed that 2% difference extrapolated out over 30 years can really cost us some big dollars. And that's essentially the cost of taxes on an annual basis. So let's look at inflation. In the last 100 years, from 1914 to about 2014, the U.S. had an inflation rate of 3.32%. Okay? And you can feel that, right? So let's look at the cost of living and how the cost of items increased just, from the 70s until now, right? In the 70s, a house was $23,000. A new car was $3,400. You could go to the grocery store and get a loaf of bread for 25 cents. And people earned, on average, about $9,000, $9,400. Okay? That's the average cost of living. If we speed this up to the 90s, so fast forward 20 years, home prices essentially went up 5 times, right? So homes were 123,000. Cars went up, 5 times, right? So almost 6 times. Just under $17,000. Loaf of bread didn't go up that much, they almost 3 times. And wages went up almost 3 times, right? In 2015 though, so fast forward to about another 20 years, things really got out of control. So home prices from the 70s to the 90s went up 5 times. From the 90s to 2015, they went up, essentially, they tripled again. Crazy. The new car, it doubled in price to $31,000. A loaf of bread went from 70 cents to $2.31. That's a lot of inflation, right? That's another 3 times right there. And wages just about doubled to $44,000. So what you can see here is that wages really are not keeping up with the cost of inflation. So, some of these smaller things that we try to do, like even increasing minimum wage or different items like that, they're really not addressing the ultimate issue. The ultimate issue is that inflation is causing things to be much more expensive. A car went up over 5 times in the first 20 years from the 70s to the 90s, and then doubled again from the 90s to 2015, versus wages just doubled from 90s to 2015. So the only portion here that's losing is wages. So that means we really have to do something beyond just our normal day job if we want to get ahead, or just honestly just stay afloat. So here's a question. Using this previous example, what will your $100 do in the next 20 years? If we assume an inflation rate of 3%, $100 today, 5 years from now, your purchasing power will decrease, right, to about $86. And the increased inflation amount to your equivalent of $100 today will be $116,000. So what does this mean? This means if I had $100 today, 5 years from now, if I went to go buy groceries, that $100 would only purchase me the equivalent of $86 worth of goods, right? So if I could buy $100 worth of groceries today, 5 years from now, if I went with that same amount of money, I would only be able to receive $86 worth of groceries, right? And so in order to have equivalent purchasing power 5 years from now, I would need to have effectively $116 in order to purchase the equivalent amount that $100 today buys. In 10 years, our purchasing power decreases only to $74. In 15 years, $64. In 20 years, we're almost at half, at $55, right? So 20 years from now, if we go to the grocery with the equivalent of $100, we would only get about half of the equivalent goods in today's dollars. So in order to keep our living, our quality of life the same, we would have to have the equivalent of $181 20 years from now. Inflation is real. It really is like a silent killer. So when you think about this, what does this mean for your retirement? How much do you need if you're going to retire in 20 years? And, this may hit home to even more of you is, what's the true cost of college and university 20 years from now? It just gets bigger and badder. So the effect of taxes and inflation on your purchasing power. Here's the rub. If you save $100 at 4% interest and you pay taxes at 25% equivalent tax rate, on $100, that's $1, right? Your net after taxes is $103. But if I have inflation at 3%, then my after-tax actual return is only $100. So what does that mean? That means that I need to earn at least 4% interest just to overcome taxes and inflation. Just to break even, I need to earn at least 4%. So your bank account that's giving you less than that, they're essentially robbing you blind. So are you gaining or are you losing? And it's really your choice. Where do you want to put your money? Nothing in the world is certain except death and taxes. And neither one of them is very good. Here's the rub, right? You make money, they tax you. You spend money, they tax you. You save money, you still get taxed in the form of inflation, right? You die, estate taxes. And so in the US, we really do have a couple of vehicles that help us mitigate being taxed so heavily. These are called tax advantaged accounts, okay? In the US, we have a couple of different buckets of accounts, and so this may be helpful to help you figure out where you want to put your money. So there are accounts that allow you to be taxed now. So those are things like your checking account, your savings account, any certificates of deposit you may have, stocks, mutual funds, right? So you put the money that goes in these accounts are really for your everyday spending, groceries, gas, that sort of thing. Even your emergency fund, okay? Those can go in taxable accounts because you need liquidity and you want to access them quickly. Different accounts allows you to be taxed later, meaning you put the money in now, it gets to grow tax-free, and only upon withdrawal are you taxed. Examples of this are 401ks or 403bs if you're in the government, IRAs, annuities, and pension plans. Okay. Then we have what's called tax advantaged accounts. So these are accounts that you either pay taxes up front and then you place it in this account and then they grow tax-free and they withdraw tax-free. Or some of them are hybrids like health savings accounts, for example, where any contributions are put in before tax and you also get to take it out. It grows tax-free and you take it out without tax. So it's pretty much, the best of all worlds. But tax advantage accounts include Roth IRAs, 529 savings plans, municipal bonds, HSAs or health savings accounts, life insurance, and long-term care benefits. So the name of the game really is to reduce the impact of taxes on your savings. So you want to consider the effect that taxes can have on your income. If you put it in tax accounts, those are taxed now. So those are like, again, savings accounts and CDs. You have tax deferred accounts. So those are ones that are taxed later. So again, so taxable accounts means that it's taxable at every stage in life. Tax deferred means I could put the money in now, but I don't pay taxes until later in life when I'm actually doing the withdrawals, as you can see in the grayed out arrows on the side. Tax advantaged accounts mean that you pay taxes today, but they grow tax-free and you never have to pay any taxes on the gains. So when you look at these examples, essentially it's a matter if you want to pay taxes on the seed or on the harvest. Okay? So taxable accounts have you paying taxes all the time. At every stage in life, you're going to pay taxes. Now, later, in between, all the time. Tax deferred accounts say, I'm going to put my seed in. I'm going to plant this seed, this corn, okay? But I'm going to pay taxes on not just that one kernel, but on the full stock that I get in the end. So I'm going to pay taxes on my harvest. Tax advantage accounts say, I'm going to pay taxes on my seed, okay? So I'm going to pay taxes on one little kernel. But then when I harvest my entire ear of corn, that's all mine because I've already paid taxes. The tax burden really is incredible, and it's only going to get worse, okay? The U.S. debt was, at the time of the forming of this presentation, $18 trillion, okay? By the time you're listening to this, it's probably even higher. The burden for every citizen, so if every citizen had to contribute to pay down the American debt, that would be $56,500 per citizen. Man, woman, child, doesn't matter. Every citizen, $56,500. And the reality is there's a shrinking tax base. Social Security was built upon the idea that there will be more workers per retiree. And if you compare that, it's not really turning out like that. So in 1945, you had 40 workers for every one retiree. Okay, you had the baby boomers. They're the largest generation there was, of course, prior to millennials. Okay, today there are only 3 workers per retiree. That's just a demographic issue, right? But as demographics goes, so goes the economy. The federal top income tax bracket is 39.6%. So you're paying almost half your salary. In California, because again, we have both federal and state taxes. In California, the top income tax bracket is 13.3%. And that does include a 1% surcharge for mental health services and taxes. So if let's just say you live in California, that combined tax rate is 52.9%. If you're at the highest of the highs, you're paying over half your income to the government in taxes. So it really begs the question, what is your tax rate? What's your tax bracket, right? And what can we do to really mitigate that, to bring you into a lower tax bracket so that these taxes really are not so burdensome? So when savings, we really want to consider the effect that taxes can have on our income. In reality, there's no need to pay more than your fair share of taxes. There's nothing altruistic or purely American or patriotic about paying more in taxes. If you can arrange your affairs so that you have a more equitable tax base for yourself, there's nothing wrong with that. You're just following the incentives that the government gives you, i.e. the tax laws. The tax laws allow and encourage people to save. So they're not something to be feared. The tax laws really are a rule book that guides you on how to arrange your affairs in a way that the government actually desires. If you're getting a high tax bill, that means that you're not listening, right? You're literally getting taxed, right? You're getting penalized for not being proactive about arranging your affairs. As well as, how can you protect your family? Because you may not realize it, but the tax of there is no taxes on accumulation of cash value in your life insurance policy. So if you were able to build cash value in a life insurance policy, those proceeds are shielded from taxes. You can also max out your tax deduction, which are, items that are allowed on your homes, like a property tax deduction, medical expenses, family expenses, having children, dependents, things like that. And also, we will be remiss if we didn't mention that having your own business also gives you deductions on items like mileage, supplies, meals, equipment, entertainment. Of course, be sure to check with your tax professional about these items. Here we want to discuss a concept known as dollar cost averaging, just to switch gears a little bit. So dollar cost averaging is an idea of how you can really average out the cost of an asset or a stock or something that you're contributing to, okay? So let's assume that you have a monthly contribution to an account of $100 per month. So as that price fluctuates, essentially you'll be able to purchase different amounts of that stock or that investment, okay? So here's how it works. Let's say in month one, the cost per unit is $100. And again, your contribution is $100, so that means that you accumulate 1 unit. Simple enough. Again, month 2, you're going to contribute your same $100. But this time, the stock price fluctuates, and now it's only $50 per unit. So, in practice, that means you get to purchase 2 units. So think of a dip in prices like it's going on sale. So if you were to go to the store and you wanted to buy apples, and each apple costs $100, and your monthly apple budget is $100, then in month 1 you get 1 apple. But if the grocery store goes on sale, has a sale on apples, and they're only $50 an apple, your budget is still $100 for apples. Now you just get to buy more apples if you stay committed to the plan, right? So now you get 2 apples this month as opposed to only 1 apple. Same thing. In month 3, it goes on a mega sale, and the price per unit is only $25. So to make math easy, you get 4 units this month. In month 4, go down even more, down to $20 a unit, which means you get 5 accumulated units. And month 5, price goes back up to $25 per unit. So again, now I get to purchase 4. And in month 6, the price goes back up to $50, just like it was in month 2. And again, I get to purchase 2 units accumulated. So what does this mean? Every month I contributed the same amount, but the number of units I was able to acquire fluctuates based on the price. That is known as dollar cost averaging. So over a 6-month period, I contributed $600. The current price per unit is $50. Okay? That I paid, my average. And I was able to accumulate a total of 18 units with my $600. So on average, if I had just put my $600 all in at month 1, I would have only gotten 6 units, because at that point in time, it was only $100 a unit, so I would have been able to purchase 6 units only. Now, some people try to time the market and say, hey, month 4 was the time to buy because it was only $20 per unit. Fair enough, but dollar cost averaging is a great way to be able to mitigate some of the risk. You get to capture some of those discount times when your share prices are low, but over time you're going to fare better than if you were to plow all your money in at one time. And so the current value of the accumulated units is $900. So another thing you want to consider is something known as risk tolerance. So here's a few examples of asset allocation. And when people think about investing, they really think about it as the weighing risk versus return. So conservative asset allocation in the form of stocks, bonds, and mutual funds is thought to be 35% stocks, 65% fixed income. Fixed income is going to be bonds, where I know exactly if I give you X amount of dollars, I know how much money I'm going to get in return. So that's why for a conservative portfolio, they're going to slate more to the 65% on the fixed income and 35% in stocks. A moderate portfolio is about half stocks, half fixed income. Moderate growth is 70-30. And aggressive is 100% stocks. You're swinging for the fences, you're going for all of it. And ideally, or in theory, the higher risk you take, the more return you're able to receive. As your life changes, your purpose changes. When you're younger, you may be willing to be more aggressive. You have less to lose and you have time to make it up. However, as you get older, you may be willing to take less risks because you just really don't have the time to make up those gains, and you don't necessarily have the energy to earn more income to contribute more. So it really begs the question of, can you handle a loss? When we talk about our potential losses, you have to think about what is the gain required to get back to even. Because it's not necessarily about, hey, I lost 10%, I have to get 10% back. Because really and truly, you have to take up that time as well. So you have to earn a higher return because now your base is lower. So it's going to take a higher percentage rate to get you back to even in true dollars, right? So in order to get back, if I lost 10%, then I'm going to need to gain 11% to get back to even. Hopefully that makes sense, right? So if I have $100 and I lose 10%, I only have $90. I can't gain 10% on my money and get back to even. 10% of $90 is only $9. So that put me back at $99, not back at my full $100. So that means I need to earn 11% in order to get back to par, get back to my full $100 that I started with. At a 20% loss, I need to gain a 25% gain just to get back to par, get back to even. At 30%, I need a 43% gain. And at 40% loss, I need a 67% gain. So really, can you handle these losses? I don't know if I can. Whew, this one hurts. At a 50% loss, I need 100% gain, right? So again, back to my $100 example. If I have $100 and I lose 50%, that means I have $50. So in order to get back to even, or my original investment of $100, I need 100% return. I need to earn my entire amount back. My entire $50 needs to be returned to me so that I can have 50 that I'm left with plus 50 that I got back in my return just to get back to even at my original $100. And at 60% losses, I need to earn 150% return, again, just to get back to even. I'm not swinging for the fences. I'm not doing anything fancy. I'm just getting back to where I started. You remember the dot-com crash in 2000? Or the Great Recession of 2008? Right? That's why those recessions and crashes are so impactful, because it really sets you back. All right. Now let's discuss mutual funds. So some people may have heard of these, some people may have not. And you know what? Sometimes you may have heard of them, but you might be a little embarrassed to ask, hey, what are these things? So let's talk about it. So what's a mutual fund? A mutual fund is a pool of money invested for you by an investment firm. It invests in a variety of instruments, items like stocks, bonds, and government securities. Essentially, a mutual fund hires someone to manage the money on your behalf, or they on behalf of all the investors. And because it's a pooled asset, it potentially reduces the risk because they're purchasing a diversity of stocks or bonds. So by purchasing a lot of different assets, then my risk is diversified out over these different asset classes or these different units. So ideally, my risk should be reduced, similar to dollar cost averaging. So mutual funds work by calculating something called their net asset value. This is known as NAV. So if you remember in workshop number 1, we discussed your net worth. Your net worth is all your assets minus your liabilities equals your net worth. A similar metric for mutual funds is their net asset value. So this is saying, at the end of the day, what's the value of all the assets in this fund? Okay? So for that, you would take the assets minus the liabilities, and you get the ultimate value of the number of shares that you have. So here's how a mutual fund works. A number of individuals all contribute money to a fund. Okay? That fund takes the large pile of money and allocates it out over a variety of assets, like stocks, bonds, or money market accounts. Over time, that money grows. Once that money grows, then the individual investors get capital gains and dividends on the investment. And anything over and above that gets returned and adds more value back to the fund. So it's kind of like a self-perpetuating engine at this point. So everybody puts money into this pot. We all go invest in these variety of assets. Our money grows over time, and we put some money back in the Tilly, and some of it goes to us as shareholders back as capital gains or dividends. So your investment in a mutual fund is part of a larger pool of money that is used again to purchase other investments. A mutual fund's pool of money has more buying power to purchase more shares than you could as an individual. So it's kind of like they get to buy in bulk. Like, think of a mutual fund as the investment version of Costco. Okay? So as an individual, I can't go unless I have a membership to Costco, right? I can't go and buy 50 hair dryers, and therefore I can't get a discount on the one hair dryer that I need because I'm not able to buy that many. But if all of my friends and I get together and we can buy 50 hair dryers, we might be able to negotiate a discount on the price per hair dryer because I'm buying in bulk. So because of that, mutual funds are able to have more purchasing power to buy more shares than you can as an individual. And mutual fund investors make money in a variety of ways. You make income returns from the fund, you make capital gains from the fund, and capital gains from the sale of your fund shares. So if the value of your fund, the price that you got in at, if it goes up and you're able to sell, then you get capital gains from the sale of your shares of the fund. So there's some benefits of a mutual fund. First and foremost, low investment minimums. A mutual fund can be an easy entry point for investing if you don't need a large amount, and you don't need a lot of money to start, right? So some funds have minimums as low as $500. There's liquidity. You can get in and out of them at any time with relatively very much ease, right? In today's advent of online brokerages, you can just do a few clicks and you're good to go. It also offers you diversification. Because the risk is spread out over a large number of industries and asset categories, this helps minimize loss. So if one industry, let's say how the auto industry got hit a few years back, because that one industry is hit, it doesn't mean that your entire investment is now going south because you're diversified over a variety of industries. And then, of course, you get professional money management. Those professional money managers, they research for you, they select, and they monitor the performance of the fund's purchases. Their whole job is to be the eyes and ears to figure out how the investment is doing and make any adjustments as needed. With that, however, comes fees, expenses, and risks. Everything has fees, right? But with any business, running a mutual fund involves costs. The funds, however, pass those costs along to investors. And what they do is they charge fees and expenses. You may hear about them as a load fee or ongoing charges like that. Now, the amount of these fees, they vary from fund to fund. And a fund with higher costs must perform better, for you, the investor, than a low-cost fund in order to generate the same returns for you. There's no guarantee as to how these mutual funds are going to perform. Mutual funds are subject to overall market risks. So they don't have a guaranteed return. They're not FDIC insured, and your investment can lose value. I mean, at the end of the day, you're still in the market, and it can go up or down. So you have to be sure that you understand the risk associated with any fund that you might consider investing in. We recommend that before you invest in any mutual fund, read the prospectus carefully. That prospectus gives you all the information that you will need to learn about that fund, their investment objectives, the risks that they're taking, performance, past performance, of course, and projected future performance, any fees and ongoing expenses associated with that fund. So when you talk about asset allocations and diversifications, here's what it looks like in real return. So diversified or moderate asset allocation portfolio, what they've done is they were able to rebalance their contributions, rebalance their account, and have an additional $1,000 monthly contributions over time. So what you can see is in the gray amount, they have a total investment of $280,000. Over time, this investment grew to $520,000, $529.36. But over time, they did something called rebalancing. So essentially, if you remember, we looked at the beginning where there were different portfolios. You had a conservative portfolio, a moderate, aggressive, so forth and so on. So as the different investment segments grow, let's say you start out with 70-30, 70% stocks, 30% bonds. Well, over time, my stocks may do better than my bonds. And so just by nature of the fact that that portion of the portfolio is growing, I may end up in practical terms with 75% stocks and 25% bonds. But I really want my portfolio to be balanced. So rebalancing means that I'm going to adjust it over time so I can get back to that ideal balance. So that is called rebalancing. And so if we look at an example of investing in the S&P 500, and of course contributing an additional $1,000 per month, because this really isn't the kind of thing that you just kind of sit and forget, right? You always need to invest towards your future if you're going to make any progress. So with additional $1,000 per month contributions and rebalancing, you can see that just rebalancing alone, because in each scenario they had $1,000 monthly contributions, but with rebalancing, the total return on that $280,000 ended up being $570,401. So they earned an overall increase of $50,000 by rebalancing their portfolio and making sure that it was in line with how they wanted their portfolio to be. And in this example, this was a moderate portfolio. So that would be that 50% stocks, 50% bonds. So what are the benefits of a mutual fund? You know, everyone thinks they're the smartest guy in the room, right? And so what that means, that leads to what we call emotional investing. So I see the market going up, I'm going to sell. I see it going down, I'm going to buy more. Or I'm going to see it going down and I'm going to get frustrated, I'm going to sell at the wrong time. Essentially, I'm trying to time the market, right? Versus buying and holding, I'm going to close my eyes, shut my mouth, and just put my money into diligent effort. And that is called the buy and hold strategy. So let's look at how those two play out over the long run. So with emotional investing, the stock fund investor that tries to time the market has a return of about 0.7%. If that same investor had chosen instead to invest in an index fund, S&P 500 index fund, and just hold it out for 20 years with purposeful investing, the average return would have been 9.2%. So investors should find a fund that's suitable for their risk tolerance over the long term, as opposed to investing in and out of the market based on their emotions, because emotional investing just costs you over time. Now let's discuss passive versus active management. So passive management. Passive management is a buy and hold strategy for investors who manage risk by allocating investments over a broad range of asset classes. And then they choose to hold those assets for an extended period of time, regardless of how the market is doing. It's saying, hey, I made a plan and I'm going to diligently and almost blindly follow this through and through so I can stay committed to my plan. That's passive asset management. Passive asset management offers broad diversification. It generally has low expenses and can be very tax efficient. Active asset management, on the other hand, is a strategy where portfolio holdings are adjusted on a continual basis in response to market and economic conditions. So in theory, this has the ability to defend against down markets, right? Because I can see something on the horizon and make changes as needed as I'm going. I'm like steering the ship actively as opposed to putting it on autopilot. Generally, in exchange for this active management, there are higher costs and fees associated with these types of accounts. So let's talk about saving for kids' education, because that's really, outside of retirement, children's college and even private schooling can be a large expense that families have to consider. So, do you know how much you need to raise a child until they're 18 years old? The average cost is about $245,000 per child. And to send this child to college, it depends on, what kind of school we're talking about. But let's say, hey, we're going to compare a private versus a public school. 4 years of private university in 2013 was about $129,000. Public school education was just over $38,000 for 4 years. Not bad. Now let's compare this out over in 18 years, right? 18 years from 2013, so about 2031. Private schooling with tuition and fees is expected to be about $312,000. Public school, while less, is still expected to triple, right? So $92,200 is the estimate of how much tuition is going to be in 2031. That's crazy, right? College debt has reached $1.2 trillion at the time of this recording, right? And at this point, college debt is higher than credit cards and auto loan debts. In 2015, the average student graduated with over $35,000 in student loans. It really is its own little financial crisis. And not little, its own really big financial crisis. So how much money do you need to save? According to a college savings calculator, you have 18 years to save for college, right? And if a college costs $25,000 a year, and remember, inflation is 3% on 3% average per year, then you need to save about $6,715 per year at 2% interest rate, which equates to about $500 per month in order to have money for your child's savings. Let's say you're able to get it into a 5% return, an account that returns you 5%, then that means you only need to contribute $400 per month. If you're able to get an 8% return, $300 per month. So, where do you want to save, really? Do you want to save in the bank that's going to give you less than 1%? Do you want to save in a mutual fund? Do you want to save in an insurance policy? There are a lot of options here, so it's really up to you to determine what is the most efficient way for you to save. Because remember, the thing that we didn't discuss here is taxes. So if this is in a taxable account, even at 8%, at $300 per month, I still have to take into account that this only takes into account inflation. I still am going to have taxes on that are due every year on any gains that I have. And do your children know that you're saving money for their college and that you expect them to even go to college? So here's a college savings calculator. In this example, we're going to start at year 2016 and go to 2033. And let's say we put in just under $5,000 per year. Okay? And in 2033, at $5,000 per year, again at this rate of return, at the end of that first year, our balance is $5,222. In 2033, we will have $146,921.98. Okay? But let's say they start going to college in year 2034. So now we're going to have to start paying this money down. So we've saved all these 18 years, $5,000 a year, only for 4 years. In year 1, we spent $42,000. Year 2, $43,000. 45 and 46 in years 2036, 2037. So at the end of the day, we had 12 cents left over after saving $5,000 a year for 18 years. But hey, it is beautiful to have the ability to do this. But wouldn't it be great if you had a way to do this that was more tax advantaged, so that even though you only had 12%, 12 cents left, at least you didn't have to pay taxes on those gains in the meantime. So there are a few ways in which you can save for college. The first one is called a 529 plan. Some of the advantages of a 529 plan is that you can use this money to pay for college. But these earnings will not be taxed, which is great. And let's say that you're the donor. You have the account. And so let's compare this to a 529 plan to what is called a UGMA or a UTMA, right? So you, the donor, you stay in control of the account versus one of these other accounts, the child takes control of the asset once they reaches legal age, which means, control really is power. And so the beautiful part about a 529 plan is that you, as the donor, the person that set up the account, you stay in control of it over time, which is great. These accounts allow contributions up to $14,000 per individual per year. And that means that you can contribute up to $28,000 for a married couple if you file jointly. And these contributions do qualify for the annual gift tax exemption up to $70,000. So let's say if you put in $70,000 over a 5-year period, then it would qualify for an estate tax reduction, which is quite nice. There are, however, some disadvantages to 529 plans. The first one is that those contributions are not tax deductible. And if you withdraw the money for any reason, and it's early, right? So you can withdraw funds early for any reason. But those earnings are subject to income tax plus a 10% penalty. So that means whatever you withdraw from the account that year will be added into your adjusted gross income. So let's say you earn $50,000. You choose to withdraw funds early, you choose to withdraw $10,000 early, then that means that you will pay taxes at the end of the year on $60,000 because that is your new income. And you'll have to pay an additional $1,000 penalty for taking that out. And probably the biggest disadvantage of 529 plans is that they will be counted on FAFSA. So FAFSA is the free application for federal student aid. So that means when you're applying for contributions from the university for student aid, 529 plans count towards that contribution. So they're saying, you save the money, we're going to use the money. So here's how financial aid works. They use a cost of attendance, or COA, and they subtract the expected family contribution. And that determines the need. So if the family is expected to contribute the total cost of attendance, then you have no need, and therefore you get no financial aid. So the whole name of the game is, how can I reduce my EFC, my expected family contribution? If you're able to reduce your expected family contribution, then you can qualify your children for need-based money that comes from both the federal and state resources, as well as any resources that the university may have or private resources, right? Again, this is just about learning how the system works. It's not doing anything wrong. It's saying, hey, what is the best way to arrange my affairs so that I can get everything that is available to me? And we do have a college planning program. If you'd like more information about it, just pop onto the forums or send one of us a ping, and we'd be more than happy to tell you more about that. Here's the thing. Determining the most cost-effective and tax-efficient way to fund a college education is really not easy, and most parents are not prepared for it. And by the time a student enters high school, they don't even understand or receive enough guidance, like from guidance counselors and things like that, towards this most important phase of the future. And so really and truly, both students and parents need to be prepared for this college admissions process. As early as your freshman year, or as their freshman year, students need guidance on how to choose the right schools, obviously what activities to participate in, courses to take, internships, sports, the whole gamut. And what are your students' interests? What is their skill assessment? And you have to be honest, what is their work value assessment? Which universities are going to be most suitable for your student? And are they prepared for the application and admissions process? Do they know how to write a good personal statement? And then one of the most important things is that FAFSA verification. How do you fill that out, and how do you make sure that your affairs are structured in a way that is most tax efficient? And how do you compare different financial aid packages? Again, that will include scholarships, student loans, grants. Navigating this is just a whole phase of things. And so, obviously, having help planning and navigating this process can be very helpful. So, hopefully, you found this workshop very helpful in terms of building wealth, focusing on growing your assets in terms of stocks, bonds, mutual funds, learning about those different tax advantaged accounts available to you, as well as college planning process. If you have the workbook, please do complete the remaining sections associated with workshop number 3. If you need help, please let's hop onto the forums and let's talk about how we can implement some of these concepts in your own personal situation. And if you have a son or daughter that you'd like to have help preparing for college, give us a shout. We'd be happy to help. If you do have a copy of the Save Your Future book, have a read of pages 6 through 21, as well as 51 through 68. And hey, hopefully you're finding benefit of this. And the only way that these concepts are going to really do you good is by having open conversations with your friends, your family, and your colleagues. So who are 3 to 5 people that you can share this information with? Tell them what you're learning. Talk to them about it. Iron sharpens iron. Hop on the forums. Let's discuss it, right? And hopefully you can refer them to not only this training, but Housing Joint Venture as well, because you find it that valuable.